Hey guys, Credible Crypto here with a new YouTube video update. This one is, I think, one that many of you guys have been looking forward to. If you've been following me on Twitter, then you know that for the past week or so, I've basically been waiting to watch developing price action before recording a video because there's a couple of different scenarios in my mind that I thought were feasible, and I wanted to see developing price action to rule one or the other out. Of course, we've been watching price moving through this range, and earlier was looking for a move up to around 57 to 58K. And then at that point, I had two scenarios in my mind, one in which we push higher to 60K plus, and one in which we reject the 57 to 58 and come back down. And as you can see, we've broken through the 57 to 58K zone, and we're now pushing up closer to the next area of interest, which is around 61 to 62K. And so that development has now allowed me to record this video because I've seen what I need to see to eliminate the idea that we may be rejecting here. And if we had rejected at 57 to 58K, there were certain implications that that would have. The fact that we've now broken out also has certain implications, and I'll cover that all in this video. So today I want to talk about what the implications are that we're rising here, whether or not we're going to get another dip to buy, how deep that dip will go, and what to look for on the upside to get very, very bullish here. So again, those of you who follow me, you'll recognize this tweet that I shared earlier today. And I said, at this stage, we're climbing higher than expected, still expecting another leg down once this move up is complete. We're leaving behind a bunch of untapped liquidity below. My bet is that liquidity is being engineered to be taken after. I'll explain this as well in the video in more depth, just like we saw the last few times within this range. Next area of interest on the upside is 61 to 62K. Above that, 66 to 69K is a line in the sand. Above that, we're full bull. And I said the rise to 61 to 62K levels does change some things, and this is why I refrained from making a video update over the last few days. Was waiting to see if we would climb this high or reject before. And this is kind of the key. As strange as it sounds, an earlier rejection would have been more bullish from my perspective. We'll elaborate on this in the next video update. And this is what I'm going to talk about in this video to start. Before I jump into this, a quick shout out to my sponsors for this YouTube video, WooX Exchange. Give them a look if you're interested in trading actively. They have both spot and perpetual futures available to those that are in accepted jurisdictions. And it's a fantastic up and coming exchange. And I've been partnered with them for 6+ months at this point. It is one of the two preferred exchanges that I have. And if you guys do decide that you're looking for a new exchange to trade on, go ahead and check them out. If you guys use my ref link, which will be linked in the comments, it will be the pinned comment. It does help me out. And so I do appreciate that, guys. If you do enjoy my content and you'd like to support, you can sign up using my ref link. Also, for those of you who have been following me on Twitter, you are aware that I do periodic giveaways from my referees on any of my partnered exchanges. So occasionally we'll be giving away both cash prizes and physical items such as PS5s. We do have a MacBook Pro giveaway coming up directly through Woo, and details of that will be announced shortly, so keep an eye out for that. But yeah, all you need to do to participate is sign up using my ref link and then make a deposit of $100 in crypto or cash. It doesn't matter. And that makes you eligible for any of these future giveaways. With that being said, guys, let's jump right into the content here. So this chart, for those of you who've been following me, is of Bitcoin, obviously, and we're in this range that I've been monitoring for some time now. Again, up here at the highs at 64K, we talked about why, we were bearish, looking for a fallback inside this range, as shared on Twitter. And, we did get that drop back inside this range. One of the primary reasons why I was expecting this sort of a deviation was, again, some of the data that we look at on Velo data, which we'll cover later in this video, but also this general pattern of this move up. And we had marked out these areas of liquidity, these marginal higher lows. Now, the first thing to keep in mind is that thus far off of these lows, what's really important is that we have corrective price action to the upside, okay? Corrective price action meaning non-trending price action. Non-trending price action means ranging price action. You only have two kinds of price action, ranging and trending. Trending is when we're making big moves to the upside or the downside, and we're making new highs or new lows repeatedly and kind of gaining ground in the upside or the downside, depending on if we're in an uptrend or a downtrend. And ranging price action is basically when we're going sideways. And ranging price action occurs when players are establishing positions for the next phase of a trend. So for the next trending movement, players will establish positions within a range. And then once those players have established their positions, the market begins trending again. And those players that have established positions then reap the rewards. So the entire point of a lot of the analysis that I do is being able to identify when we're seeing ranging versus trending price action. Because if we can identify the start of a new trend, we can catch a monster move. We did that back here at 39 to 40K, and we caught this monster move to the upside. So again, all we're doing here is trying to identify another one of those sweet spots, another one of those low risk, high reward entries to catch the next trending movement to the upside, which, of course, if you've been following me for any period of time, you know that I'm expecting 100K plus over the coming months. So First thing to note is that typically we look for these trending movements to start off of key swing lows. They don't have to, and I've talked about this in the past as well. It's not a requirement, but they often do. And so the first thing that we look at whenever we put in a key swing low is the subsequent move off this low, is it a trending move or is it a corrective move? And trending moves, as I've explained in prior videos, are basically a series of higher highs and higher lows, or a 5-wave move. We call them 5 waves because you have a series of higher highs and higher lows. You have a low, you have a high, you have a higher low, higher high, higher low, higher high. When you combine that, it equals 5 waves. That's all we're saying. It's a way of viewing market structure. So off of the low that we have right now, you can see that the move up was what we'd call a 3-legged move or a corrective move. And 3-legged moves or corrective moves, by their very nature, are not impulsive. They're not trending because you don't have a series of higher highs and higher lows. You have a low, a high, a higher low, and a higher high, but you don't have a series, meaning multiple higher highs and higher lows, right? Subsequent higher highs and higher lows, which makes a trend. And so even after this stage, when we got this 3-legged move up and we got this long correction and we started pushing up, I said, look, this is corrective. We're probably going to come back down. And that's exactly what we did. Now, the key here is that we were already expecting, watching for a potential deviation somewhere above these highs. But what really sealed the deal was this buildup of marginal higher highs here, okay? And basically what this is, you can view it as liquidity being engineered to the downside, okay? What this means is that players that are entering here on leverage or are entering in trades, they're typically placing their stop losses way below key swing lows. And so what happens here is you get a series of marginal higher highs building up a series of higher highs. To a novice, they would think, okay, this is a trend. We have a higher high, a higher low, a higher high, a higher low, a higher high, and they're thinking, wow, we're trending. To those who are more familiar with, the type of analysis that I do, you'll understand that in order for a real trend to be present, you're not looking for overlapping price action. You're looking for strong waves, and the higher highs and the higher lows should be separated by strong, what we call impulsive movements, right? So very vertical moves followed by consolidations or corrections, and then vertical moves followed by consolidations and corrections, et cetera, et cetera. So what you have here, despite this looking like, okay, well, a series of higher highs and higher lows, or what a novice may think is an uptrend, this is not a proper uptrend. This is not a proper what we call impulsive move. Rather, this is a corrective move or a ranging move or a choppy move, right? We're overlapping repeatedly, right? We are making technically higher highs and higher lows, but there's all this overlap, which implies that there's not really strength behind this move. It's more so a kind of forced grind to the upside. And why is there a forced grind to the upside? To get people to long this supposed breakout. And then as people long this breakout, you get people that are selling into these longs and then pushing price down, triggering all the stop losses that are here set by people that think that we've started a new trend. So that's the logic behind watching for these marginal higher highs in a corrective movement. Okay, that's key. 2 things. You're looking for marginal higher highs and you're looking for corrective price action. If you're getting corrective price action, you know that a correction is likely coming. That becomes more likely when you see these marginal higher highs being built up, kind of preserving these lows so that we can quickly run them and cause a chain reaction of stop losses to push price lower where, again, buying occurs. So we saw that on this initial move up, and then we came down, and you'll see that essentially what we're looking for is price to move below all of these lows, because you may have some stops below these initial lows, you may have some stops before these lows, and the most conservative people that are entering trades will probably place stops below these lows, right? Because this is where they envision being the start of the uptrend, right? And so what you look for then is you look for price to come back down and move all the way below the origin of all these marginal higher highs and higher lows. And that is this level right here. So that's kind of the minimum target that we look for in terms of downside. As you can see, we got that minimum target. Now what's interesting here, and I pointed this out on Twitter as well, is that we have another key swing low here, right? And you'll see that as we came down and took all of these built up higher highs and higher lows, what were we doing? We were forming another series of higher highs and higher lows in almost the exact same fashion here, almost an identical replica, but this time on the downside. And so once again, I tweeted and I called it deja vu. I basically said we're seeing the exact same thing here to the downside. Now we've resting liquidity to the upside, and we're looking for a deviation below the lows the same way that we got a deviation above the highs of this key swing high. We're looking for a deviation below this key swing low, and then we'll probably see a reversal back up to take all of these highs, take all this liquidity, okay? Now at this point, 2 things could have happened. Now you'll see that as price actions develop, that's exactly what we're now doing. And we've already almost come and taken, right, the minimum target. And as I've said, the minimum target is the origin of all these series of higher highs and higher lows. So we're almost there to that minimum target, okay? And at that point, the job is done. We've taken the liquidity to the upside, and now we're thinking, okay, what's the next move? Now, On our way to the upside here, there was two scenarios that could have played out. And as I mentioned at the start of this video, I talked about how there was potential for us to reject around this region here, okay? And if we rejected around this region here, it meant one thing. If we broke through and headed for this higher liquidity, it meant a second thing. And again, that's why I held off on making this video, as mentioned at the start of this video, because I wanted to see if we were going to reject at this area or continue up to take all the liquidity to the upside. As you can see, we did break through this region. We're now about to take all the liquidity to the upside. This has a couple of implications. The first thing that I'd like to point out is, what do we see here once again? A series of higher highs and higher lows in choppy corrective PA, almost exactly identical to what we saw here and what we saw here, once again occurring, okay? And so this once again tells me that this move up is not impulsive, and it is basically liquidity being engineered for another dump back down to the downside, okay? And depending on what your stance is here, this is either good news or bad news, right? If you're looking to get positioned lower or looking to buy more in a dip, this is great news. If you are tired of the chop and you're tired of us going up and down within a range, and you've been waiting for us to explode to the upside, this may not be the best news. But what I will say is that if you're patient, the rewards will come. And irrespective of how long we chop within this consolidation, as I maintained for a very long time now, the next move is a massive breakout to the upside, basically like what we saw here. And again, just for some perspective, the move that we're seeing now, if you think this is taking too long, I just want to show you something here. Our last consolidation back here at 30K prior to this run up to 70K took this amount of time. The current correction, as it stands, has taken just shy of that amount of time. Okay, so this correction, while it seems long and it seems crazy and it seems never ending, for all intents and purposes, is nothing out of the ordinary or nothing that should cause any sort of concern, because we saw the exact same thus far length of consolidation at 30K before we went 2x within a number of months, right? So don't freak yourself out by thinking that this long consolidation is bearish, or that this long consolidation is a sign of weakness, or that this long consolidation is a negative thing. It's not. It's exactly what happened here. Consolidation that precedes expansion. And thus far, it's taken about the same amount of time. Okay, so nothing to be concerned about. Now, with that being said, let's talk about what the implications are here. Again, I said in my tweet, recalling back to the original tweet that I shared early in this video, as strange as it sounds, an earlier rejection would have been more bullish from my perspective. Well, let's elaborate on that right now. Why would a rejection at 58 to 59K, why would that have been more bullish than what we're seeing now? So as we know, guys, typically when we're completing a correction or a major consolidation phase, there's typically two ways that these things end and conclude. Two ways that they conclude before the next major move to the upside begins, okay? The first way, which some of you may be familiar with or may have heard this term before, is what we call a V-shaped reversal. And a V-shaped reversal basically means what it sounds like, and that is that we get some sort of pretty significant mass liquidation event or big flush out of leverage, and price almost immediately rebounds from that point and then continues to climb near vertically into a recovery. And we call that a V-shaped recovery. We saw this during the COVID crash, for those that remember that, both in traditional markets and on Bitcoin. That was a typical V-shaped recovery. Actually, we have one here that I recall off the top of my head on the SPX right here. This is a typical V-shaped recovery. On the higher time frames, this is what we call more of a V-shaped recovery, which is like a very aggressive drop and then almost an immediate rebound and recovery and continuation. We saw one here on the SPX, actually the bigger one right here. This was a little bit more drawn out. I'd say this is more of a consolidation, but we saw a very aggressive one here. We saw a V-shaped recovery here, a V-shaped recovery here. And again, the most notable, the one that I was referring to earlier, the COVID crash, is the V-shaped recovery here, okay? So the point being that this is one way that we can see a bottom. And then the second way that we typically see a bottom before expansion is the other form of bottoming, which is more of a lengthier process, which we call like forming a base or accumulation base, okay? So you have two options. You have a V reversal or you have an accumulation base, okay? And so the idea was that an accumulation base basically just means sort of a reduction in volatility, a tightening of consolidation in a tighter and tighter shape until we get a very aggressive and abrupt rip out of that consolidation. Now, this entire thing, as I've been saying, is a larger reaccumulation structure, but for a typical non-V reversal, we would expect, instead of like what I've depicted here, we would expect something that takes a little bit more time and kind of bores people to death. And that is something that we call an accumulation base, which again, is some form of tighter consolidation and then a very aggressive rally, right? So again, you either get a larger, longer accumulation base, or you get that V reversal, which is a dip like this and then almost an immediate rally, okay? So those are the two main options that we look for in any sort of reversal. And the reason that I said that a rejection here in the red zone would have been more bullish, I'm going to explain to you right now, is because if we had rejected in the red zone, then my hope was that a rejection here in red would be setting us up for a little accumulation base here over the coming days. And that would set us up for the expansion by probably the end of this month. Okay, so that would be another week or two of consolidation. As you can see, we'd be having a tightening consolidation structure, a tightening wedge, whatever you want to call it. You can call it a triangle, you can call it a wedge, you can call it whatever you want. The point being that we have a constriction of volatility into an apex, and then we would get ideally a very aggressive rip to the upside, which would basically be the start of our impulse to 100K plus, the start of this type of up-only price action that we've been talking about. So that is why I said that a rejection here would have been ideal. Okay, now what does it mean that we've broken above this region? Okay, if we'd rejected at 58K, I had very, very strong conviction that these lows at 49K would not be retested. Okay, if we rejected at 58K, I was pretty convinced that our bottom was in here at 49K, and that we were essentially forming a smaller accumulation base, I should say, within a larger accumulation base. You can view this entire structure as a larger range, and then we would have been, the deviation below the range, and then we had a reclaim and a higher low, and then some further consolidation at the lows, and then a rip out of this range. Okay, so that would have been ideal. Okay, and I say that because it would give us a quicker breakout to the upside. It would mean limited downside, okay, meaning the bottom would have already been in here at 49K, and it meant that we would probably start impulsing by the end of this month, okay? Now, I'm not saying that we can't, wrap this consolidation up in the next week or two. I'm not saying that it's impossible now, but I'm saying that the odds are probably higher if we had rejected here and started tightening and reducing volatility and constricting, right? Now, instead of that, we've broken above this level. We're probably going to head to, 62K, or at least above these highs here at 61K. And that just means that things have gotten a little bit more drawn out, okay? What I think that means is I'm no longer as confident in this being our absolute bottom, because now I view this, because of the price movement that we're now getting to the upside, now I view this as a move up to these range highs that we previously deviated above. And in the same way that we look for an accumulation base with a triple tap at the lows, which is basically a swing low put in, and then a lower low put in, and then a higher low put in, we call that a triple tap. The same way that we look for one at the bottom, we can also look for one here using this deviation. And so now what we seem to have is a potential triple tap forming here, but this time it's forming to the upside. And typically when you get this sort of a triple tap, as we call it, or this sort of accumulation top or bottom, the minimum target is the lows of the range. Okay, so what we have here now is a range identified with a key swing low. We have a move up, a deviation above the highs, fall back inside. Now we're looking for a lower high here. Okay, instead of, if this were reversed, we'd be looking at a key low put in. We're looking at a deviation, right? And then we're looking for a higher low into that deviation for a move to the highs, to target these highs. Now, again, this is an inverse chart. So really what we're seeing now is, again, that same idea, but now we're looking at it from the opposite perspective. And so what this means then is it increases, in my opinion, the probability that we may see sub 49K again. Depending on what your position is here, this is either a blessing or it's a curse, right? I will say, for those that are upset about this, it's not a bad thing that we see sub 49K again, okay? Do not think that just because we wick below these lows again, it's the end of the world. Do not think that it's the start of a bear market. It changes nothing on the higher timeframes. As I've previously said, in my last video, I talked about how this is a massive high time frame area of demand, right? The most significant high time frame level on the chart, a logical place to see a reversal from. And in that same video, again, this is the last video that I shared on Bitcoin, if I recall correctly, we talked about this weekly level right above it that thus far has held price, right? We front ran the biggest, most logical place for a reversal, and instead we were holding this kind of like intermediate level right above it, okay? All this means, if we see a wick below 49K, is it means that we test the most logical place to see a fall and reversal. So it's not bad by any means. It's not unhealthy. It's not an issue by any means. It does mean, if you approach this the right way, you may get some fantastic buys on Bitcoin, which is, in my eyes, a very good thing. Okay, so keep that in mind as we approach, these local highs at 62, 63K. So with that being said, the fact that we've now broken up above that 58K rejection, basically, long story short, means that instead of forming a little base here that I earlier would have liked to have seen or would have expected, instead of doing this, because we rejected here at 58K, we now may be coming down and taking these lows and then seeing one of two things, okay? And those two things are what I previously talked about, either a V-shaped reversal after these lows at 49K are taken, okay? So either something like this with continuation, or the other option is we're making a larger accumulation base or a triple tap like we saw up at these highs down at these lows. And in that case, what would happen is we dip into this high time frame zone, we would bounce, and then we would see a little bit of a retest here for a higher low, and then we would impulse. Okay, so these are the scenarios that come into play because of this larger rise to the upside. That is the main thing that has changed over the last couple of days based on developing price action. Another thing that I would like to add on, again, I share with you guys multiple probabilities and possibilities because there's always multiple possibilities and probabilities. I cannot predict the future, but what I can do is map out what I think are reasonable courses of price action so that if and when they do appear, you guys are prepared for them and you don't freak out. And I can also tell you what I believe to be, out of the various scenarios that I show you, the most logical or the most likely to happen. Okay, that doesn't mean that it's guaranteed to happen. That just means that my confidence level is the highest for X scenario to happen out of X, Y, and Z scenarios. I will always tell you what I think makes the most sense to occur out of the few options that I may show. Any option that I show I think is generally reasonable, but some are, in my opinion, a lot more likely to occur than others. I want to add that I've had some people point out or kind of ask me if something like this is possible. They're viewing this as potentially a corrective triangular structure, which for those of you who are familiar with corrective triangular structures, the idea is that we get a series of 5 legs. We call them an A, B, C, D, E, but basically we have multiple taps of the highs and lows of a consolidating structure like this. And what this then leads to is a breakout after the completion of the last leg. And the last leg doesn't need to tap the trend line. Okay, so in this scenario, what you then expect is, okay, rejection here, and then us to come down, and then us to kind of consolidate over here, and then actually rip up from here. This would be the most bullish scenario. It would kind of keep the idea of like a tightening constriction here and a triple tap base forming here. It would keep that alive, and this would be incredibly bullish. This is the most bullish scenario that exists right now, but I will say that I don't find it to be the most likely. And again, the reason for that is because of the way that we've moved up here. Again, leaving all these untapped higher lows. And I'm going to zoom in here in a second to show you that there's a lot more detail to this than meets the eye. But the point is that while this scenario looks like, something that you can argue is realistic or feasible, which I'm not saying it's not, I don't think it's high probability at all for me personally, okay? If when we get down to 56K, we see some massive absorption or signs of buyers stepping in here instead of waiting for the flush, or if we get some sort of a flush here and then see absorption and start seeing a squeeze back to the upside, okay, then maybe we're getting that scenario. But as it stands, based on everything that I'm seeing now, I don't find this to be a very likely scenario, okay? But I'm sharing it because I've seen people ask me about my thoughts on that. With that being said, I'm going to zoom in here. I'm going to show you a little bit more detail about what's going on here in the lower time frames and really kind of get you guys to understand how to view these things. Again, the triangular idea is the most bullish of them all, but I don't really think it's feasible or realistic. It could happen, but I just don't give it a very high probability at all. More likely, I think that we're headed for these lows at this stage, especially if we tag, 62, 63K plus. It's also worth noting that the line in the sand for bears is getting above. You'll see these repeated higher highs that have been building. And so anything above 70K, we can't be full bull until we get above that. So as I previously said, this is the next area of interest at 62K in my tweet, right? 2 areas of interest, 62K. Above that, 69 to 70K, which is this region here. Until we get above that, we can't become full bull. It is what it is, guys. Back when we were trading here at 70, 69, 70K, the same thing happened. I literally said, you need to be cautious here because I think we're going to dump. And I got met with, people saying you're crazy. We're at the highs, we're going to break through. And then we broke down, right? So the key is just because we get close to these highs, just because we're close to the highs, doesn't mean that we should be overly bullish where we've seen repeated rejections and lower highs every time we get to this region. Okay, if we get to this region, it's technically the most likely place to see a rejection. So don't get uber bullish at the most likely place to see a rejection, just like people did here, 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 and here, okay? Each of those times we were able to see data on Velo data, which I use frequently, that told us that this move was likely to be faded. And we called it as we saw it, and it worked out well for us. So again, keep in mind, just because we climb higher than expected here doesn't mean we flip massively bullish without seeing more data to support the idea. Now, with that being said, we've marked off our line in the sand and 2 areas of resistance to the upside. Let's go ahead and zoom in a little bit. And let me show you guys what I'm seeing here in the lower time frames, which makes me more confident that we're probably going to reject here shortly and come down to take up all these built up lows down to at least 52.4K, and most likely, in my opinion, just under 49K for a wick. Let's go ahead and zoom in here. So I'm going to go to the 15-minute time frame, and I want to show you guys something. So within this series of higher highs and higher lows, you can actually see that almost entirely on this move up, we've had repeated bouts of higher lows forming. So we have liquidity resting below all these lows, okay? We also had these lows built up here, right here. You can see higher low, higher low, higher low. So you can say there's liquidity, untapped liquidity below those lows. And so basically you have untapped liquidity on like every freaking time frame here. I can show you more. So we have this move up here. We have these lows right here. Again, more untapped liquidity. Then when we go and zoom in even more, you can go down to like the 5-minute time frame. Once again, you can see here untapped liquidity below these lows. So anytime you have these like marginal higher lows that present themselves, you can almost guarantee that you have stop losses resting below this low, this low, or this low. And the reason that we consider these like marginal higher lows so significant is because typically when one of these marginal higher lows gets triggered, because of the stop losses that are usually resting below, when these stops of this marginal higher low get triggered, the sell pressure sometimes pushes us down to these lows, and then these stops get triggered, and that sometimes will push us down to these lows. And so we get cascading liquidations or a cascading trigger of stop losses. And what that looks like in practice, when we get that on these small time frames and then these larger time frames and then the largest time frame, what that looks like oftentimes, depending on how much leverage is in the system, is a very aggressive flush to the downside. It can happen almost in one big candle, like we've seen here. You can see here, look at this. Actually, this is a perfect example. Check this out. So we had all these built up higher lows. As soon as we hit the first one right here, we melted all the way down and got here. We took out these lows, 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 all in one single candle. Okay, so that's the idea and why we care about these marginal higher lows, because there's liquidity resting below, and as stops start getting triggered, it causes a liquidation cascade, and then that triggers more stops, and before you know it, we're at the bottom of the range again. And so you have not only on the highest of time frames, you can see the very obvious repeated higher lows in a corrective manner. You have these little pockets of more liquidity on the lower time frames that we can identify, literally all the way up, one here, one here, one here. And so when price eventually does stall out, whether it be here or whether it be higher up, and selling does start to occur, we get very rapid price depreciation. And so that's the logic behind, expecting a liquidation flush or a flush to the downside due to the buildup of these repeated higher lows and due to the buildup of this liquidity, or engineered liquidity as I like to call it, because you have someone essentially walking price up with limit bids, and I tweeted about that on Twitter as well, walking price up with limit bids, preventing these levels from getting run and forcing price higher. And when that entity decides that he's had his fill or now wants to get cheaper Bitcoin, they will stop walking price up. They'll stop placing bids underneath price and will start pushing down. And then everyone that's been buying or longing this on leverage all of a sudden finds their stop losses getting triggered, and before you know it, again, we're at the bottom of the range. So with all this being said, the point being made here is we are not out of the woods. And as much as I would love for us to go higher and break out tomorrow and see 100K within 2 months, it's not about what I want. It's about what the market gives us. Some of you may remember I placed options bets for 80K Bitcoin by the end of July and August. Those options bet expired worthless. Believe it or not, I would have loved to have seen increasing price action to the upside, because I would have made money if we were able to get to 80K by the end of August, but we didn't. And so even when we were at the highs here at 70K or at the highs here at 69K, I was not screaming from the rooftops to buy. I was saying we're probably going to correct, as much as I hate to say it, because it delays the move to the upside, and which means that my call options are going to be less profitable or will not be profitable at all. As much as I hate to say it, we're probably going to go down again. And so I repeatedly called for rejections at these highs based on the data that I saw at the time, despite the fact that it was in my interest for Bitcoin to go up faster. So it's not about what I want, it's about what we get. And so right now, what we're getting, unfortunately or fortunately, depending on how you look at it, is we're getting corrective price action to the upside on very, very high open interest with a series of marginally higher lows. It's looking like we're going to get at least one more wipe down to the downside. Okay. With that being said, guys, let's take a quick look at VLO data. Actually, you know what? I talked a lot about VLO data in my recent tweets, and I talked about how this incrementally higher high price action, the reason why it looks corrective. I talked about how you can identify when you're seeing impulsive versus corrective price action. So this tweet here, I talked about how to identify impulsive versus corrective moves, or a hint on how to identify them. And I specifically use VLO data to point out why this move up looks corrective, and it supports the idea that we're going to get a correction down, right? So aside from the naked price action chart telling us that it's likely that these lows get taken, I also explained why it's likely based on the data that we're seeing here on VLO data. Go ahead and look at that. I was going to cover it in the video, but I already covered it on Twitter, so there's no point in me repeating myself. So go ahead and look at that on Twitter, and it'll explain this. My last few tweets today have talked a lot about the ideas that I'm presenting here in this video. This video kind of just summarizes most of those ideas and adds a little bit more context to them. But go back and look at my recent tweets to get an idea of more depth behind this stuff. But again, what we're looking for now is two potential options, right? Rejection here, most likely, and then a wick below 49K ideally. And then either we're going to get a very sharp, aggressive V reversal, or we might get a little bit of a range forming here, depending on if we get, again, a V reversal or a more gradual accumulation base, right? That is the bottom line here. Most likely, I think we're going to reject by the time we get to 62K, this initial region. If we get past that, right, then potentially a push to 66 to 70K. But again, not until we clear these highs. And really, in an impulsive manner, doesn't make sense to get super bullish. Let's quickly talk about CRV here, guys. I shared another chart on Twitter actually showing an alternate scenario. This is one that I was mapping out just earlier today, but this is the scenario that I shared on Twitter. And both of these are possible. This is me preparing for either outcome. So we'll go ahead and actually make this one a different color so it's easier to tell the difference. So we have the blue scenario and we have the green scenario. Previously, when I tweeted about this, I said basically which path we take is going to be dependent to some extent on Bitcoin, right? So if Bitcoin is able to avoid correcting long enough, then CRV may push up to these highs here at 29 cents and take the highs. But ultimately, I am looking for one more flush below 25 cents before the real move to the upside starts. And then just like Bitcoin, we have two potential possibilities, either a more aggressive V-shaped reversal, which is the blue direction, or a more gradual accumulation base, which is the green path, as I've shown here. But the bottom line is, in both of these scenarios, a dip below 25 cents is a worthy buy. The only difference is one of them has us clearing the range highs first, and one of them has us failing to do so. And again, like I said, that's going to be primarily dependent on whether or not Bitcoin breaks down sooner rather than later, or continues climbing a bit longer, allowing CRV to get to these highs, okay? In either scenario, we're looking for one of these two to play out. And then I'm targeting, of course, the same targets I've had for some time now, 40 plus cents. And above that, we're looking at the upper target at 60 cents, okay? Keep in mind, guys, that these are lower time frame targets. Obviously, higher time frame targets for those that are not actively trading. $2 is the first main area of resistance, like on the highest of time frames. This is really where things get serious at $2. Above $2, we're looking at new all-time highs, above $6.80. So as you can see, I've already marked off. Some of you may now kind of understand what these lines mean. What do they mean? We have a series of higher highs, untapped liquidity resting above these highs. So the idea again is that once we manage to get above 87 cents, it should be a pretty aggressive shot to around $2, right? So these initial resistances are kind of what's keeping us down. So we can expect pushes into these initial areas, potential consolidations or chop. And then eventually, once we clear these two lower time frame targets, then we should hopefully have a straight shot to $2. Once we clear that, a straight shot to new all-time highs. Guys, that is it for this video update, guys. I hope you guys enjoyed it. If you did, please like, share, and subscribe. Remember to check out Woo using the link below, and I'll catch you guys in the next one.